if I was going to plan on, increasing my valuation over the next 5 to 10 years, what are the levers that you see that I can be, pulling on to be most efficient in increasing the enterprise value of my company?
Going back to kind of those main value drivers, you have growth. Because obviously when someone buys something, they're buying for the future income producing, right? So you have to have systems in place for there to be growth in the future. That's what someone's going to pay for.
Right, without you there, for instance.
Exactly.
Okay.
Right.
Welcome to P&L, Priorities and Lifestyle, with your host, Rob Schultz. Rob is the founder and president of Schultz Wealth. All opinions expressed by Rob and his guests are solely their own opinions and do not reflect the opinion of Schultz Wealth Limited. This podcast is for informational purposes only and should not be relied upon for investment decisions. Please refer to our website for more information.
Welcome everybody to P&L, Priorities and Lifestyle. I'm your host, Rob Schultz, and today my guest is Brandon James, CFA.
That's right. Yeah.
That's how we got to know you, right? It was through the CFA Institute.
Exactly. I met Austin at a CFA function, and that's how we got connected.
Yeah. Now I am not a CFA, so I don't speak CFA. But when you go to a CFA function, I mean, do y'all just kind of like talk in ones and zeros and stuff?
Yeah. It can get kind of nerdy after a while. But yeah, no, it's definitely a big accomplishment that I'm proud of that I never want to do again.
Oh, explain. So a lot of folks that are listening, they don't know what CFA is. Can you kind of explain to us that grueling process?
Yeah, sure. So CFA stands for Chartered Financial Analyst, and I have to say I'm a charter holder. I can't say
that's
I'm a
right.
CFA.
Yeah.
So there's lots of rules around that, and I can't say that it'll that it'll help me guarantee returns or anything like that. It doesn't do that.
Okay.
But
so all of your disclosures are out now.
Right.
Okay. Good. Okay.
But it's a credential for the financial analysis community. Set of 3 exams. They do them all the time now. They used to only do them like once a year.
Yeah, and like practically nobody passes them. I mean, it's
not
really,
on the first time.
It's a really low pass
rate.
Rate.
So it's the exams used to be 6 hours an exam. Now I think it's down to like 5 hours an exam. And each exam basically has like a 40% pass rate on it.
Yeah.
And if you think about it, 40% pass level 1, and then only 40% of those people that pass level 1 pass level 2. So it just it gets harder and harder.
It's a multiplier.
Right.
I have to be a CFA to be able to do that calculation in my head. But
there you go.
Yeah, it's pretty low. Yeah.
Yeah.
Well, that's cool. So congratulations on that. Yeah. And that's how you and Austin met. And then we've worked with some clients and kind of gotten to know each other and really appreciated all the work you've done. Now, you do valuations, and that's why you're here, is because we're going to talk about the valuation process for primarily businesses. Can you kind of explain kind of what your typical day looks like as far as what that means?
Sure. So, I'm at my company, Stout. I'm a vice president.
Yeah.
Essentially, I'm a project manager. So, the originators, the salespeople, managing directors bring in the work, bring in the projects. And then, I take it from there, do all the client communication. And then I'll usually have an analyst or an associate to leverage down work underneath me.
Excellent.
So, I guess a typical project that comes in, get the proposal signed, get the retainer in the door. And then from there, we send out a kind of a standardized data request. So we're requesting, 5 years financial statements, trailing 12 months, a forecast would be great, 3 to 5 years. A lot of companies don't have that. Some of them just have a next year budget. Some of them don't have that.
Okay. So trailing 12, all that kind of stuff. So that's interesting. So a lot of times you're looking for a forecast, and maybe even, are you looking for like a business plan as well sometimes? Or is it more like for valuation, more like kind of what they think is going to happen?
Yeah, we want to get their thoughts on the numbers, basically.
Yeah.
Because,
Okay.
we know we're experts on financial analysis, but we're not necessarily experts in the industry of the company that we're doing the
Sure.
project
So it'd be
on.
any industry y'all can value.
We're a generalist, right?
Okay.
So, and eventually, you kind of work your way in, and you start doing more and more industries, and can maybe become an expert in those industries. And there's some industries that kind of require, some nuances to it, some different ways of looking at it. Oil and gas,
Sure.
healthcare,
Yeah.
biotech, those sorts of things. Definitely, it helps to have more experience in those types of
We're
projects.
just
to be able to do
valuing
those
the
projects.
assets, like biotech. I mean,
Right.
it's like goodwill. It's like the technology itself, and then
Yeah,
oil
yeah.
and gas is you have to be
Mineral
able to,
interest.
the
There's a
reserves.
lot of exactly. Yeah. But in general, I can do evaluation on any industry. And it's all about looking at the numbers that we get from our client, but then being able to have those conversations with the client to understand the numbers. And in those conversations with them, we get to understand the industry trends, risks, those sorts of things. So I was talking about kind of the typical timeline of a project. When we send out the data request, we get that data, and then we usually take about a week to start populating our model. And then at that point, we schedule what we call a due diligence call or a management call.
Okay.
And then that's where we can really have a detailed discussion with management to kind of get a sense of kind of the history of the company, milestones that they've achieved, in their own words, kind of their strengths and weaknesses that set them apart in their industry. And then we can really get into like detailed questions on the financials of the company.
Gotcha.
Yeah.
Yeah, we've been on at least one of those.
Sure.
I think I recall
Yeah.
with you. Very interesting. So, why would I want to get a valuation if I'm a business? What are the reasons why I pay for one?
Well, there's lots of reasons. One reason is that you have to. if you're a public,
Usually the case, yeah.
Yeah, if you're a public company, we do a lot of corporate side valuations. So if there's an acquisition, they have to do a valuation for purchase accounting. So
I see. So like it could be a private company that gets bought by a public company, and you have to come in and value
the assets. You have to value the assets, right?
Okay. Yeah.
Because they, when they acquire them, they market to market, right?
Sure.
So you have to figure out what the fair value, the market value of the assets.
Do they bring you in like they post close to do that? I'm just curious.
Yeah. So for that they do.
So they're gonna. So devil's advocate. So a lot of times, like for instance, my buddy Brad Purefoy, who's an investment banker, he'll always say, he's like, well, you're worth what somebody's going to pay for you in the market, and that's what you would expect from somebody whose job it is to try to get top price for their client in the marketplace. But that's not necessarily why you get a valuation, I guess. You get a valuation for other reasons.
You can. And so for that purpose that we were just talking about, where the public company's involved, that's for financial reporting. So they need to put those in their financial reports. They have to bring in a third-party appraiser to value those assets.
Okay.
What I've kind of, most of my work is involved in the private client services side.
Right.
So your privately held businesses, when you start talking about succession planning, passing on interest to your kids, gifting, that's where we can come in on that too. So in order to kind of pass down these interests in these companies that these business owners own, there's certain limits that you have each year that you can pass along. And in order to figure out how much of an interest in the company you want to pass, you need to know what the value of that company is, and you need an official valuation report that is tax compliant.
Yeah.
So in that case, when you do your tax return, you include our valuation report with that whenever you send it to the IRS.
Yeah. So estate planning, business succession. I mean, that's where we see you for sure. And that's would you say that sometimes you have different criteria for that valuation than you would like in the open market, for instance?
Certainly.
Yeah.
So when you think of the value of a business, there's certain hierarchies, right?
Okay.
So at the very top, you have a controlling, 100% interest in the company. And that's the value of the company. If I were to package a controlling interest in the company and go sell it on the market, that's what I could get for it, right? When you talk about estate planning, private client services, you're going to start getting down to minority interests, right?
Yeah, and a minority interest is not worth as much as if you own the whole thing because you have no control in essence.
Right. So when we do estate tax valuation projects, there are certain discounts that are accepted by the IRS, right? So to go from the controlling interest at the top, which is considered marketable, because it's much easier to sell a controlling interest in a company than a minority interest, right? So you have controlling marketable at the top. Your first discount is called a discount for lack of control.
Okay.
And that's basically going down to a minority interest, right?
Okay.
So you have your top controlling interest, then you discount it for lack of control, then you have a minority interest, marketable, because when you think about going from a controlling interest to a minority interest, you have the control discount, but you also have a marketability discount because a minority interest in a private company is very hard to sell, right? It's not marketable. It's not marketable.
Right.
So there's another discount for lack of marketability on there. And when you start taking those combined, that becomes a pretty big discount to the value of the company, and is helpful to the business owners. They can pass on more interest in the business to their kids. They can pass on more under that certain dollar value threshold.
It accelerates their gifting.
Right. Exactly.
Essence. Yeah.
Yep.
Yeah. And that's a standard thing. That's always for instance, if you're going to go sell your business to somebody and, prior to doing that, a lot of times they end up here. Right.
Yep.
And we'll sit there and go, okay, well, that's awesome. That's a big number. And if it's a big number, it has estate planning associated with it because it means that you have to take into account gift and estate tax, and that's when we start getting with the estate attorneys and structuring limited partnerships or trusts or whatever it may be, create some lifetime gifting, and then we come get you and we get our valuation.
Yes, exactly.
And it all hinges on the valuation. I mean, it's always been fascinating to me how we can have this whole, and it's always done in flow charts, and you can have all these flow charts of everything. It's also esoteric until you actually have a value for you.
Yeah. And then all the work can be started and completed all at once.
Well, it can. And then that's when it actually takes shape and you see, what that structure is going to need and what it's going to require. And that's when it gets down to brass tacks. That's when it gets real.
Yeah.
So I always appreciate it when we get the valuation back, because that, I feel like that really is kind of when it all becomes real to the business owner.
Right. Yeah. No doubt. And a lot of times, I would say most times that we're working with, the business owners really have no idea what the value of their company is, right?
Yeah, I would agree. Or they have they have something in their head, and it's not based on anything.
Yeah, exactly.
And we all do that, right? I mean, we just think, oh, it'd be great if someday I could sell my business for X.
Yeah.
Okay. Well, let's take some further steps there. What needs to happen for that to occur? What are you basing that valuation on?
Right.
All these kinds of things. And, that all gets kind of pushed to the side sometimes as we just work in our business. But yeah, so when you do a valuation, you're actually, going through and getting into the details of this business from a third party perspective. And, really trying to come up with what this valuation is. And my assumption is like it's really important that you get this right.
Yep.
Because
Well,
with IRS,
the IRS will come back. Yeah,
Absolutely,
if you
they
start
will.
making crazy assumptions to really decrease that value, you have to be able to support them.
Yeah.
So, and there's definitely cases where they send it back and make you get another one done, and then you have to pay penalties on the taxes you didn't pay the first time, and
we don't want
really
that.
messy.
Yeah,
right?
we don't want that.
Mm-hmm.
So when you're going through and doing a valuation, it's very similar, obviously, to maybe what you could potentially sell a business for, or that minority interest, or whatever it may be. Can you help us understand maybe some of the things that you see that really drive value within a business as you look at all these different businesses from all walks of life?
Sure. I mean, obviously, the industry that they're in, there's certain industries that just don't have that high valuation multiples, physician practices, things like that.
Why is that?
Because it's a little harder to kind of pass on, the intangibles. So a lot of the extra value, the intangible value in that company is built into the providers. If you have, a widget manufacturer that just, runs completely autonomous to the owner, they can step out. You can pass that on, and the acquirer can either bring them in and do just as well, or there's potential for synergies there for them.
Okay, so yeah, I can see that, and they're kind of tired. So the owners, in a lot of cases, is doing the work as well. But what about like for instance in dental, you see DSOs, like for instance, go with decent multiples. How's that different from a physician? Or do you think those are pretty low too compared to other things?
Yeah, I haven't done too many dental practices, so I'm not certain on what the difference is.
Okay.
There.
What about like an engineering firm, or I'm trying to just think of different professionals, or an attorney firm? Are they kind of in that area
they're
as well?
Still kind of in the lower side of multiples. Really where you start seeing high multiples is in the tech space.
Yeah.
The engineering and consulting side, you can see some high multiples there.
Okay.
So yeah, that's an industry where they tend to bring in some high multiples.
I'm trying to think why that is. Possibly because, I guess an engineering firm a lot of times has a very long-term client that is continually coming back to them.
Yeah, and that's,
you've got that continual revenue stream. Obviously, tech makes sense to me because it's high growth, and you're trying to go off of the way we think of valuation is it's a present value of future cash flows.
Right. So you touched on a couple things there that are true value drivers.
Okay.
Right? So when you say kind of in the engineering firm, they have, long-term clients, they have, repeating revenue, you're really talking about kind of the sustainability of their revenue, right? And that's a big thing.
Okay.
And it goes into risk, right? So the value drivers that, when we look at multiples, or when we look, market multiples, and we want to compare it to these other companies, or we look at kind of the discount rate that we're going to use on the cash flows. The value drivers that we typically look at are growth. You mentioned that.
Okay.
Profitability, earnings. An acquirer is paying for cash flow.
Yeah.
And then risk. And within risk, is another driver that can be its own thing, but size. So larger companies tend to transact for higher multiples, especially when you're looking at it on like an EBITDA basis or on a profit basis.
So explain EBITDA.
Sure. So EBITDA is EBITDA, earnings before interest, taxes, depreciation, and amortization. So when you start going down the income statement or the profit and loss statement, you have your revenue at the top, you go down to gross profit, and then typically, the next one you see is operating profit, right? And when you think about it, you look at all the expenses, they have all the operating expenses, and they'll have depreciation and amortization in there with it. So what we want to do is we want to look at it at that operating profit, but without accounting for depreciation and amortization. So that's what EBITDA is. It's the profit you get, basically the operating profit by adding depreciation back to it.
Gotcha.
And the reason we do that is because depreciation is a non-cash accounting item, right? So when we're looking at when we're doing a valuation, we want to know what the cash flow of the company is, and that's what that's what people buy on. Is usually you typically see when people do offers for acquisitions, it's typically on EBITDA multiple basis, or you see earnouts in transactions or purchase agreements. It's usually on an EBITDA multiple basis.
Okay. Yeah. So that's a good thing to know in your business. And then, do you think so? Are there common multiples that can you go and most people, I would say, have an idea as far as the multiple, like for their industry and things like that. And that's something you can generally go off of, I would suspect.
Yeah, in general, those tend to work out about right.
Yeah. And they go up and down based upon what's going on. But yeah.
Right. Yeah. It could be some sort of government regulation on the horizon that could really suppress multiples, things like that. Those kind of rules of thumb are good. There's a lot of information out there. You can just Google, what are this industry multiples. And that's a part of kind of our valuation process.
Yeah.
We have multiple methods that we kind of, we don't just do one thing and say that's the value. We want to look at a few different ways to value a company.
You're going to do it from maybe a multiple standpoint. You're going to go and use another valuation. For instance.
So I'll just say that, there's in valuation literature, kind of the industry belief, there's 3 approaches to value. So there's an income approach, there's a market approach, and there's a cost approach or asset-based approach.
Okay.
So your income approach is based on the income producing properties or the income producing abilities of the company. So that's, like you said, the present value of cash flow. It's a discounted cash flow method, right? Where we take their forecast, we do certain things to it, and then we discount those cash flows back at an appropriate discount rate, right? Also within the income approach is called the capitalization of earnings method, is what I usually called it. It's called something else now at Stout.
Is that kind of like a cap rate, or is it?
It's very much. It's exactly like that. You're taking kind of a 1-year cash flow.
Yeah.
Getting down to kind of an ending cash flow number, and then you're putting a cap rate on it.
Yeah. Which real estate trades around here on a cap rate. I've never really understood it as just like a single driver of, for certainly purchasing something myself, but.
Well, and really the when that really comes into play is when you have kind of a mature company that doesn't have, a lot of growth potential.
Yeah.
Maybe has 3 or 4 years of very similar sales.
So that makes sense.
And EBITDA.
Yeah, because, it would be a mature property that you would use that for. So same for a business. Okay. Yeah. Cool.
So, but then if they're showing, 20% growth, 15% growth, 10% growth, you really want to do a discounted cash flow method, because that's what incorporates kind of those higher growth assumptions.
Okay. Yeah. Uneven cash flows.
Right.
Yeah.
Yeah.
Which is CFAs do that kind of thing.
Yeah. So then your next approach is a market approach. And these are the ones that we typically use. So like a DCF, that'll be in pretty much all of the valuations I do. Then the market approach, we do 2 different methods under that. We do what's called the guideline public company method. And so that's where we look at sales or multiples on sales and EBITDA based on public company trading prices. So we'll screen for comparables or comps that are similar to the target company or our subject company.
Okay.
And then based on trading prices as of whatever date we're looking at, we can calculate multiples on sales and EBITDA of those public companies, right?
Yeah.
And then that gives us kind of our industry standard multiples that we can apply to our company.
Okay.
And then the other method within the market approach that we use is the transaction approach or merger and acquisition approach. So that's when we can screen for actual acquisitions that are happening within that industry. And we want to use like recent transactions, obviously, but based on the transaction price and the target company's sales and EBITDA, we can calculate multiples on those as
How do you
well.
get data on that?
We have a few different sources. A big one we have is called Capital IQ from S&P, so S&P Capital IQ, and it's just a financial database.
Okay.
They have public company data on every public company out there, basically, right? Because
Gotcha.
it's all publicly available. So they take all that, they scrape all that publicly available data, put it into the database, and then make it easy for us.
Yeah. So for public companies, but is there a way to get that data on private companies, or is it? No,
not typically. And when I talk about like a transaction approach through Capital IQ, really the only transactions that we have data for are when a public company is involved, because they have to release that information. There's some other databases out there that include like private company transactions that just do surveys and stuff and have people like go out and ask, hey, what'd you pay for this, blah, blah, blah. And we have access to that too. So that's another way to kind of look at it.
Okay. All right. Good.
Yep.
Okay. So that was the two. And then the third one you said was asset-based?
Cost approach or asset-based approach. And when you're looking at what's called an ongoing business, one that's going to one that's assumed to operate, into the future, that you usually don't do that. So
yeah, because that's
the value of the assets, right?
Okay,
you look at the balance sheet, you make adjustments to market value, and that's your equity value.
Right.
So that's really for companies in distress or figuring out a liquidation value of the company.
Gotcha.
Yeah. So and those are the three kind of main approaches to valuation that all valuation firms use.
Okay, gotcha.
They're all the same.
Okay. So if I was going to plan on increasing my valuation over the next 5 to 10 years, what are the levers that you see that I can be pulling on to be most efficient in increasing the enterprise value of my company? What do you kind of see when you look at stuff like that?
Yeah. So going back to kind of those main value drivers, you have growth, right? So
just grow.
Well, grow and not just grow, because obviously when someone buys something, they're buying for the future income producing, right? So you have to have systems in place for there to be growth in the future. That's what someone's going to pay for.
Right. Without you there, for instance.
Exactly.
Okay.
Right. Yep.
Yeah. That brings up an interesting point, because a lot of times this comes, we'll have somebody who's maybe looking to sell and they're working through the process and thinking about it. And then all of a sudden they can see themselves, they see this growth that increases their value, but they're valuing it at a higher level than maybe even the potential buyer is.
Sure.
And and it happens quite a bit.
It does happen. There's people that, they have an intrinsic value in their company that, is what the value is to them, but that's not necessarily what someone's going to pay. Right. So when you start talking about, you've built up this business, you've had a lot of growth, your acquirer is going to look at, okay, when we buy them, what's going to happen going forward? Are there systems in place that when this person leaves, the company doesn't fall apart, right?
Or, for instance, certain companies will hit demarcation points, where the current leadership can't get them past that.
Right.
They do a strategic sale, and the new people coming in can see that there is growth there with them on the deal,
Yep.
and maybe you get value out of that.
That happens a lot,
Yeah.
When you start talking about strategic acquirers, maybe you don't have, sophisticated systems in place that are necessary to support the growth going forward.
Yeah.
This larger firm may have that, and they may be willing to pay a little extra based on those synergies
Because they know that
realize.
they know they can get you
Yes.
there.
Yeah.
Okay.
And they're not gonna, they're not gonna say, oh, we can bring you in and it'll add, $10 million to the company, so we'll give you an extra $10 million. They're going to split it with you, obviously.
Absolutely. Yeah.
But that definitely happens. And then you have like what's considered financial buyers, PE firms and stuff that don't necessarily do that, right?
Right.
But it may be easier to find a buyer, a financial buyer, than it is to find a strategic buyer sometimes.
Yeah. So growth.
Yep.
What else? What other ones do you see that really drive it?
So earnings, profitability.
Okay.
You have to be able to show that the company can produce cash flow, because again, that's what people buy, right?
And then different industries have obviously different profitability numbers they work off of.
Yeah, you could be a car dealership and they're in the 5-6% margins. And then you could be a consulting firm and they're in the 20-25% margins, right?
Yeah.
It's very dependent on industry, and that's when you look at kind of companies preparing for an exit or preparing for an acquisition. That's a big part of it, is really cleaning up the expense side of it to prove that this company can run at these revenue figures with these smaller expense numbers.
That makes sense. What about on the balance sheet? I mean, do you ever get into stuff on there that you see maybe on private companies that kind of makes it hard to value? Or is that
just in general, a lot of private companies are, they're running certain expenses or holding certain assets that may not necessarily matter to the operations of the company,
Yeah.
And obviously you're not supposed to be running personal expenses, but there's things that get in there,
of course.
That's a part of the process, is really kind of figuring out those adjustments. That's what the acquirer is going to do, and that's what preparing for an acquisition, as a business owner, you probably need to be doing or thinking about, is looking at your financials and saying, okay, if we do sell, what are the things that can really fall off on the expense side that'll increase my profits and in turn increase my acquisition price?
Yeah, but not only on the P&L, but also on the balance sheet as well.
Right.
I don't know. I mean, because I see all kinds of things on the balance sheet that really can take time to clean up, like loans to shareholders, stuff like that. You need to get all that nice and neat.
There's you see stuff with 6 different line items of related party receivables, related party payables, and it can be kind of a mess to really figure out, okay, what's a true receivable here, what do you actually have to pay out? We definitely see those things quite a bit.
Okay. All right, so grow, be profitable,
and then the last one is risk, right? So
big one.
And
we saved the big one for last.
and risk encompasses a lot, right?
Oh yeah.
When we talked about kind of the sustainability, what industry are you in? Are you captive to kind of the government regulations, because those change all the time, right? So
regulatory risk is a thing,
right?
Yeah, absolutely.
Yeah. Or concentration risk. I had a client in the construction industry, and 95% of their work was through one large company, right? And they have a great relationship with them. The large company is very strong, but you don't know what's going to happen. So there's a lot of risk in that company.
Oh yeah.
Right. There's key man risk, like in the case where, if you as the business owner do everything for the company and you step away, well, then what's going to happen to the company, right?
Yeah. Or if you have key people within the organization that you don't have the ability to, keep on at post-transaction, for
Right.
instance.
Exactly. Yeah. So, and all that has to do with the sustainability of those cash flows, right?
Yeah.
It's all about, what we're seeing today, what's the risk that that's going to fall off? And any of those things can increase or decrease that risk.
Yeah, we talk about risk a lot on this podcast. Because I think, I know that business owners, myself included, a lot of time, we live in our business with the risks that are clear and present on a day in, day out basis. And you just kind of get used to them and you accept them.
Yep.
And you forget about them.
Yeah.
And that can be really dangerous, especially if you're looking at some point to do a transaction. Those are the kinds of things that I think it makes a lot of sense to try to tie up and use your brain power on trying to solve.
Well, it's all a process, right? And a lot of times business owners, they don't think about the value of their company or these valuation drivers until an offer comes in or until the very last minute, right? But there's a proactive approach that you can take to ready your company for acquisition, right?
Oh, yeah.
It's those, increasing profitability, those things we talked about. But on the risk side, it's, putting the systems in place that alleviate those risks.
Yeah.
Right. That allow your company to function going forward without interruption. And those are the things that business owners can really start thinking about today, even if you're not planning on exiting for another 3 to 5 years. You really want to start thinking about those things.
Oh, yeah, I totally agree. I think it should just be a process that we go through, that we make sure that we're always thinking about all these things and don't wait till the last minute for sure. I was going to kind of ask, so you've been doing this for a while now, 10 years, I guess, doing valuation stuff. Okay. And if we can go back and talk about some of these discounts, because I'm sure that some people are sitting there going, what discounts? Why do we want to discount the value? And just kind of walk through kind of what a typical transaction may look like where we're doing that. So somebody's thinking about selling their business. It's going to be a big number, like I said before.
Yep.
And then we're gonna try to create some structure around that and use these discounts to, in essence, transfer this value at a lower value than what it will be when you sell it.
Right.
That's the trick, right?
Yeah, and you can do 2 different types of valuations on the same company, and you'll come up with 2 different values.
Yeah.
Right? It really depends on the purpose of the valuation. The discounts really come in on, when you start talking about estate planning. And, when you start talking about actually doing an acquisition, you're going to sell a controlling interest in theory.
Yeah.
Those discounts are not going to be there.
Yeah.
On the estate side, there's the regulations kind of plainly state that these discounts are accepted because they, for estate purposes, the valuation of that entity is at fair market value. And that has a specific definition. It's the price that a willing buyer and a willing seller would transact with each knowing all the facts, right? But additionally, the value for that purpose should not take into account any sort of like synergies in that hypothetical transaction, right?
Okay.
So you're really looking at bare bones. What's the kind of, what's the financial value of that company, not the strategic value, right? But then when you start getting in an acquisition, you probably want to sell to a strategic, then you can really start thinking, okay, what if they bring me on, what kind of cost cutting things can they do? What kind of synergies could they realize? That's where, the value can really go up from there.
Yeah. The synergy, the culture, we have a client that we've worked together. I won't mention who it is that, is kind of going through a process right now. And they just have a really, really cool culture. that no question is driving value within a potential strategic sale.
Yeah.
There's no doubt about it, but that's not in the numbers.
Right. Exactly.
So that's a good example of there's just a very justified difference between that true fair market value that you're talking about and what you can actually sell for.
Yeah. And that brings up a good point that, all of this is relative. And, when we look at the financial statements, we can mechanically calculate a value, but there's a lot of qualitative things that really need to be considered when you start thinking about, okay, what's the true value on the market for this company, right? And that's why we do a detailed management call. That's why we go back and forth. There's some companies, I'm not going to mention who they are, but there's some valuation shops out there that do very, almost like automatic valuations where they just kind of plug in some numbers and it spits out a value, right? And that may be okay for a while, but it's not, it's okay until it's not okay, right?
Right. Sure.
And you may be able to get those through the IRS or whatever, but as soon as it becomes an issue, then none of it was worth it, right? So that's where a good valuation is a process, and it's really going back and forth with the management team or the owners of the company, and understanding what's the typical kind of what's the SWOT analysis for this company. I want to know the strengths, weaknesses, opportunities, and threats. Those are the intangible or kind of qualitative things that can really drive value that don't really pop out on the financial statements.
Oh, no question. And those are the things that are so exciting. And that's what every entrepreneur is searching for, right? To find what that is that makes them different, that gives them a distinction, gives them an edge, and therefore, potentially a higher valuation. Yeah.
Sure.
Yeah, no question. Yeah. Well, cool. Well, man, I think we hit it pretty good here. Is there anything else that you need to talk about with regard to valuation you think we didn't get into? Or
so I'll just mention, there's a lot of different types of valuations. I focus on business valuations. Yeah. So that's
where we live a lot.
The value of the business, right? There's also real estate valuations, very different than what I do.
Y'all do those, but you may not.
We do
within your project.
So at my firm, Stout, now we do all of these types of valuations. Now I've worked before in the past for smaller boutique valuation firms, and we just focused on business valuations.
Gotcha.
But yes, at Stout we do real estate valuations, machinery and equipment valuations.
Oh, cool.
They're all different things. And I'll also mention kind of the other reasons for getting a business valuation done. We talked about the gift and estate side. We talked about the corporate valuations for financial reporting. I do a lot of litigation support. So, a lot of times in a divorce, there's a company involved. It's good business right now.
I never knew about that, but my no good brother-in-law definitely brought the value down on his business quite a bit when I was sitting there watching that process with my sister. So I know exactly what you're talking about. Really? It's not worth anything?
When they're trying to figure out what the marital estate is, they need to know what the value of the business is, right? So they'll bring us in for that, but also on the litigation, we'll do economic damages. So if something happens, someone does something to a company and, their value goes down, well, we need to be able to quantify that, right? So we do that as well. And then we also do work on, we also do valuations for management planning, which is kind of exactly what we're talking about, preparing for an acquisition. So
you think it's worthwhile maybe to just kind of go through a process like that, maybe prior to going to market?
Oh, definitely.
Yeah.
And for negotiation purposes, I mean, we've had times when, I did one recently where it was a physician practice, and they got a letter of intent from another company that was rolling up all these physician practices. And, he thought it seems a little low, so they just wanted to get their own third-party valuation done. And we were, I was able to provide them a valuation and show them kind of why I think it's higher and where their value's not necessarily the best at. And, they were able to get more money from it.
Oh, okay.
And
Got
a lot more than what they paid for my valuation. So,
that's what you're looking for.
Right.
Okay.
Good money spent.
So go get a valuation just so know that you're in the ballpark, or that, know that if you get a deal and it's in that range, that it can make sense. Yeah.
And when you start talking about it for those purposes, you're not talking about big dollar projects.
Yeah, that's what I was going to ask you. So those don't cost to as high a level as the one where you've really got to make sure that the IRS isn't going to.
Yeah. So for your financial reporting or tax reporting, you have to have a full report to back it up. And that's at the end of the day, that package can be 100, 150 pages sometimes. So that those projects are much more. When you start talking about just doing a valuation for management planning, we can do a set of exhibits for you at that, and that's it.
Sure.
And have a call with you about why we think what we think. But it's just something that you have in your back pocket. And I definitely think it's a very good tool for business owners as they go out to market.
Cool. Yeah. Okay. And then, like in a buy-sell agreement as well.
Mm-hmm.
I know that we see a lot of those, not as many as we wish to see, because everybody should have one.
Mm-hmm.
But a lot of times those will call for a third-party valuation in case a partner dies or something like that. And then that's when they bring you in.
Yeah, exactly.
For something like that.
Yeah.
Okay.
Yeah, they'll bring us in for those purposes. And then we do my old firm before we got acquired by Stout, and now Stout, and kind of, I think one of the reasons that they were looking at us was, they were headquartered on the West Coast and had a big biotech presence.
Oh, wow. Okay.
And so when you start talking about valuation,
of course, we've got a lot of biotech in Fort Worth too. I mean, really, kind of.
Yeah.
I mean, you always hear. I think there's a couple of incubators and things like that.
Yeah, no doubt.
Yeah. Okay.
Yeah. But you really see it on the West Coast.
Sure.
And we'll do what's called a 409A valuation, which is a valuation for share-based compensation. So, you talk about startups out there, pre-revenue companies that can't necessarily offer the dollar compensation packages that other, more established firms can. They'll usually issue options in those instances. So we'll need to value the company for those options.
Oh, that makes sense. Yeah. Okay.
Obviously a lot of different reasons to perform a business valuation. But I think the ones that really interest me the most are those, private clients, the family business owned companies.
Yeah.
The companies that, you can tell that they are rock stars as far as what they do. Right. Yeah. But maybe don't have the necessarily knowledge to really understand what the value of their business is. And those are the ones that I really like to help.
That is cool. Yeah.
Yeah.
That's good. Well, Brandon, thanks for coming in today.
Yeah.
You're right here. So you grew up here, right?
Yeah. Irving, born and raised.
We're in our Las Colinas office, and here you are, back home.
Yep.
Okay.
Yeah. No, it's a beautiful office.
Yeah. Thanks. Yeah, we just moved in here, and we really like it up here. It's very centrally located.
Yeah. Well, they're really building a lot around here too, like the downtown Las Colinas area. They got a lot of cool stuff over there now.
It's pretty exciting being up here. We like our Mansfield office too. I like it because that one's like 2 minutes from my house.
That's a nice little benefit.
It is a huge benefit, but it's nice to be up here where people from all over can kind of come here, and we do most of our meetings here in the office, so it's worked out really well. So we appreciate you coming in and talking to us about valuations. This has all been really helpful. If somebody wants to get a hold of you and talk further about some of this, what's a good way for them to contact you?
So my email address is very, very simple. My name's Brandon James. Email address is bjames@stout.com.
Okay.
And I can give my office number. I don't have it memorized, but
yeah, just give it to us, and we'll put it in the show notes
Perfect.
as well.
Yeah.
So, yeah, we can do that. We'll put your office number in the show notes, and then obviously your email. Everybody out there, feel free to reach out to Brandon if you have questions about valuation, whether or not one makes sense for you at your current juncture. This has been a great discussion. I think this is something for all of us to go back and think about our businesses from the standpoint of what's it worth to somebody else.
Sure.
Always a great discussion. I want to remind everybody that you can subscribe to this. So we put this out every other week on whatever podcast platform you listen on. It's probably there. And we appreciate everybody listening in. Have a great week. Take care.